You know that feeling when something new, kind of complex, hits the mainstream, and suddenly everyone seems to be talking about it, but maybe the details are still a bit fuzzy.
Oh, definitely. You know it's important, but maybe not exactly why or how it works.
Exactly. I had that just the other day. My hairstylist, super smart, but not exactly a finance news junkie. She just asked me straight up, okay, should I be buying Bitcoin now? My brokerage app has it. And what is this ETF thing anyway?
Yeah. That's usually the sign, isn't it? When it pops up in those everyday conversations, you know it's really crossed over into broader awareness.
Absolutely. And her question just nailed that gap, between the buzz and the actual understanding. There's so much noise about Bitcoin ETFs right now.
Yeah.
Hype, confusion, it's all mixed together.
It really is.
So that's why we're doing this deep dive today. We've gathered a bunch of material articles, research from Forbes, the International Journal of Science and Research Archive, fingerlakes1.com, CoinLedger, and we even looked at a Reddit discussion thread.
Yeah, to get a sense of the real questions people have.
Our mission here is basically to cut through all that noise for you. We want to pull out the key nuggets from these sources, help you understand what a Bitcoin ETF actually is, why it's such a big deal, financially speaking.
And really dig into the differences, the opportunities, the risks, especially comparing it to just, owning Bitcoin directly from an investor's point of view.
Yeah, think of it like we're exploring this new bridge being built, connecting traditional finance with, the sometimes kind of intimidating world of crypto.
That's a good way to put it.
So let's start there. What exactly are these Bitcoin ETFs?
Okay, so at its core, Bitcoin ETF stands for Exchange Traded Fund. It's basically an investment fund. It trades on regular stock exchanges like the NYSE or NASDAQ.
And its job is to track the price of Bitcoin.
Exactly. It aims to mirror Bitcoin's price movements.
So the whole point is you can invest in Bitcoin's price, sort of, without actually having to buy the Bitcoin yourself. Like no crypto exchanges, no figuring out digital wallets or worrying about losing private keys.
Precisely. That's the main appeal for a lot of people. It simplifies things dramatically. You buy shares in this fund, and the fund handles the Bitcoin side of things.
And you just manage those shares in your normal brokerage account, like you would with, say, Apple stock.
Just like any other stock or ETF, yeah. Through your standard account.
Okay, that makes sense. Now, the sources mentioned there are actually a couple of different kinds, right? But one type is really driving all this recent excitement.
That's right. The big one, the real game changer that got approved in the US in early 2024 and sparked all this mainstream chat, is the Spot Bitcoin ETF.
Spot ETF, okay.
These funds, they aim to hold actual Bitcoin as their underlying asset. So when you invest, the fund is literally buying and holding real Bitcoin.
So your investment is designed to go up and down directly with Bitcoin's actual market price.
That's the goal, yeah. To track it as closely as possible. It gives you that direct price exposure, but without the technical headache of handling the Bitcoin yourself.
And these approvals involved some, really big names in finance.
Oh, absolutely. We're talking major players, BlackRock, Fidelity, folks like that launching these products. That institutional buy-in, plus the regulatory green light, that's a huge part of why this is such a landmark moment.
Gotcha. And the other type, you mentioned there was another one.
Right, the Futures Bitcoin ETF. These actually existed before the spot ones got approved, but they work differently. They don't hold Bitcoin directly.
Okay.
They invest in Bitcoin futures contracts. These are basically agreements to buy or sell Bitcoin at a set price on a future date.
And the sources said those futures ones might not track the actual Bitcoin prices closely and could be more volatile.
There's a key distinction, yeah. They can sometimes deviate from the spot price, and the structure is just different. So really, the main event, the focus of all this buzz and most of our sources is the spot ETF, because it's about holding the actual asset.
Okay, spot ETFs. Got it. So we know what they are now, but why? With a huge buzz, why is this considered such a massive development?
Well, the number one reason, coming through loud and clear from the sources, is accessibility. For years, if you wanted Bitcoin, you had to navigate this whole separate, often confusing system, right?
Yeah, crypto exchanges, wallets, private keys. It feels like a lot to learn. And risky if you mess up.
Exactly. It's a significant barrier for many people. And the ETF, well, it just tears that barrier down.
How so? What are the key advantages the sources point to?
They consistently highlight a few things. First, just ease of access. If you've already got a brokerage account, Schwab, Fidelity, Robinhood, whatever, you can probably just log in and buy shares of a Bitcoin ETF. Simple as that.
Like buying any other stock.
Yeah.
No new platforms, no extra hassle.
Exactly. Use what you already know. Second, They're seen as regulated and secure. Now, this needs a caveat. It doesn't protect you from Bitcoin's price going down.
Right, the volatility is still there.
Absolutely. But the fund operates under regulatory oversight, like from the SEC. This gives investors a layer of protection against certain things, like maybe fraud or the provider disappearing, that might feel riskier in some corners of the direct crypto world.
Okay, a familiar regulatory wrapper.
Yeah. And third, liquidity and convenience. Because they trade on major stock exchanges, you can usually buy and sell them easily during normal market hours. Generally pretty liquid.
I remember seeing that quote, Tristan Tama calling ETFs a familiar, regulated financial tool that bridges the gap. That really sums it up, doesn't it?
It really does. And this accessibility, it's not just helping individuals. The sources make it clear. These ETFs are actually fueling the market. They're bringing in huge amounts of institutional money.
How did that work?
Well, when big investment firms or funds buy shares of the ETF, the company that runs the ETF, like BlackRock, has to go out and buy real Bitcoin to back those shares.
So ETF demand translates directly into Bitcoin demand. I saw some crazy numbers mentioned in the articles.
The scale is pretty stunning. Yeah. One source mentioned inflows hitting like $1.6 billion in just 1 week in April 2025. Another noted cumulative inflows topping $4.3 billion by May. That's consistent, heavy buying pressure.
Wow. And this unlocks something really big for U.S. investors specifically, right? Retirement accounts.
Oh, that's massive. Monumental, really. For ages, putting actual Bitcoin into your standard IRA or 401k was basically impossible, or at least very complicated.
Right. You needed special accounts.
Exactly. But now you can buy these Bitcoin ETFs through your regular brokerage, which means you can potentially hold that Bitcoin price exposure inside those tax-advantaged retirement accounts. That's a game changer for long-term planning.
Plus, you could argue having the big Wall Street names involved and the SEC's blessing kind of gives it a stamp of legitimacy for traditional investors who might have been skeptical before.
It definitely helps remove some of that stigma, yeah. And you see it in the holdings. One source mentioned the big ETFs like BlackRock's IBIT, Fidelity's FBTC, ARKB, BITB. Together, they hold something like over 550,000 Bitcoin. That's huge, rivaling what some countries hold.
Okay, so let's get practical. Someone's listening thinking, oh, okay, I'm interested. Maybe I want to dip my toe in. What are the actual steps involved in investing in a Bitcoin ETF?
Sure. The sources lay it out pretty clearly, and it's basically like buying any other ETF or stock. First step, you need a brokerage account that actually offers Bitcoin ETFs.
Most major ones do now.
Seems like most do, yeah. So check with yours or open one with the provider that carries them. That's step one. Choose your brokerage.
Okay, step two.
Step two, select the right Bitcoin ETF. There are like over a dozen spot ETFs approved now. The sources mentioned the big ones, IBIT, GBTC, FBTC, ARKB. They're not all identical though. Different providers, maybe slightly different features or structures.
And that leads directly to a really important point the sources stressed, fees.
Oh, absolutely critical. Step three, analyze the fees and expenses. Every ETF charges an annual management fee. It's called the expense ratio.
And that comes out of the fund's assets.
Yeah, it reduces the fund's return slightly each year. For these new spot Bitcoin ETFs, the fees are mostly pretty competitive, ranging from maybe 0.2% up to about 1% per year.
But some are higher. I think Grayscale's was mentioned.
Right. Grayscale's GBTC, which was an existing trust that converted, has a noticeably higher fee, around 1.5%. So comparing these fees is really important. Lower fees mean more money stays in your pocket over the long run. Some even had temporary fee waivers at launch to attract investors.
Makes sense. Fees compound. Okay, what's step four?
Step four, decide how much to invest. And this is key. Remember, the ETF wrapper is familiar, but Bitcoin itself is volatile, super volatile sometimes.
So don't bet the farm.
Definitely not.
Yeah.
The sources often suggest strategies like dollar cost averaging or DCA. That just means investing a fixed amount regularly, like say $100 every week or month.
Helps average out the price you pay, reduces the risk of buying right at a peak.
Exactly. Smooths out the ride a bit. So once you've decided how much, step five is simple. Buy your shares.
Just place an order through the brokerage.
Yep. Log in, find the ETF ticker symbol you chose, put in a buy order. You can use a market order buy at the current price or a limit order where you set the maximum price you're willing to pay.
Standard stock trading stuff. And finally,
step six, monitor and adjust. Like any investment, keep an eye on it, see how it's doing, stay aware of market news, periodically review your whole portfolio, and maybe rebalance if things get out of whack. Standard investment hygiene.
Okay, that process does sound very accessible, very normal compared to the usual crypto hoops. But, and this is a huge but that came up again and again in the sources, especially that Reddit thread, buying a Bitcoin ETF is not the same as owning Bitcoin directly, is it?
Not even close. This is probably the most fundamental difference, and it highlights two completely different ways of thinking about Bitcoin.
What's the core distinction?
It boils down to ownership and control. When you own Bitcoin directly, like you buy it on an exchange and then move it to your own wallet where you control the private keys.
That's self-custody, right?
You possess the actual digital asset. It's a bearer instrument like cash. Whoever holds the keys controls the Bitcoin, and it's non-permissioned. No bank, no government can stop you from sending it, theoretically.
Okay, but with the ETF?
With the ETF, you don't hold the keys. You don't hold the Bitcoin. You own shares in a fund. The fund, through a custodian like Coinbase, is the custodian for BlackRock's IBIT. They hold the Bitcoin.
So you own a claim, an IOU.
Kind of. You own a security that represents Bitcoin held by someone else. Some on Reddit called it a permissioned asset because your ability to access its value depends on the brokerage, the ETF provider, the custodian, these intermediaries.
Which brings up that trade-off. Convenience versus responsibility. It sounds huge.
It's massive. Direct ownership puts all the responsibility on you. Security is paramount. You have to learn about wallets, seed phrases, securing your keys. If you lose your keys or get hacked because you weren't careful.
Toof. It's gone. No one to call.
Pretty much. Very little recourse. That freedom comes with heavy responsibility.
And the ETF, it basically outsources all that.
Completely. It's designed to be, as some put it, almost foolproof from that personal security angle. No keys to manage, no wallets to secure. The big regulated firms handle custody. For many, that offloading of technical burden and risk is the main attraction.
Okay, then there's the whole usage aspect. What can you do with it?
Another major split. Actual Bitcoin, the asset itself, well, you can use it. You can send it to anyone, anywhere. You can potentially use it in DeFi, decentralized finance applications. You can store it offline for decades, pass it on directly.
It's designed to be money, potentially.
Exactly. For people who believe in that vision, the usability is key.
But you can't, like, buy groceries with your ETF shares or stake them in DeFi.
Nope. Not a chance. The ETF share is purely an investment. It gives you exposure to the price of Bitcoin. When you sell your shares, you get cash back. US dollars. You never touch the actual Bitcoin network or its functions.
Fees are different too, structurally.
Right. If you hold Bitcoin directly in self-custody, once you've bought it, there are no ongoing fees just for holding it. With the ETF, you pay that management fee, the expense ratio, every single year based on the value of your holding.
Even if the price goes down?
Doesn't matter. It's a percentage of assets. It's a small drag on returns, but it's constant. And it adds up over time compared to just holding the coins yourself, fee-free.
And trading hours. Bitcoin trades 247.
Right.
All over the world.
Yep. Non-stop market. But ETFs, they trade on stock exchanges.
So only during regular market hours. 9.3 to 4.00 Eastern, Monday to Friday, basically.
Exactly. And that Reddit thread really hammered this point. What if there's a huge price swing overnight or over the weekend? If you hold the ETF, you're stuck. You can't react until the market opens. You miss that window.
That's a definite limitation. What about regulatory oversight and security? Different angles there, too.
Definitely. With direct ownership, especially self-custody, you are the security. Your practices, your hardware, that's the protection. If you leave coins on an exchange, you're trusting the exchange's security and solvency.
Which hasn't always worked out well.
No, it hasn't. ETFs, on the other hand, are regulated products. The fund manager is regulated. The custodian holding the Bitcoin is usually a big, reputable firm subject to oversight. The shares themselves might even have SIPC insurance.
But that insurance covers the brokerage failing, right? Not if Bitcoin's price crashes.
Correct. It protects your shares up to a limit if the brokerage goes bust, not the value of the underlying asset. But crucially, the ETF structure introduces counterparty risk, meaning you're relying on third parties. What if the custodian gets hacked? What if the ETF issuer faces financial trouble? There's a layer of trust involved that isn't there with self-custody. You might get cash back eventually, but it's a different risk profile.
Which ties into that point about government control risk that came up.
Yeah, this was a big theme, especially in the Reddit discussion. Assets held within the traditional regulated financial system, like ETF shares in a brokerage account, are inherently subject to government rules. Freezes, seizures, theoretically possible.
Whereas self-custodied Bitcoin.
Proponents argue it's more resistant because you hold the keys directly outside the traditional system. That Executive Order 6102, the U.S. gold confiscation in the 30s, was mentioned as a sort of historical analogy, a warning about holding assets through intermediaries that governments control.
So there's a real philosophical divide there, too. Sovereignty versus relying on the system.
Absolutely. It taps right into the core ethos of Bitcoin for many.
Yeah.
Decentralization, self-ownership.
Okay, but despite all those differences, the tax advantage for ETFs seems like a massive practical draw, particularly for people just focused on investment returns.
It's probably the single biggest practical win for the ETF, especially as highlighted by CoinLedger and others. The ability to hold this Bitcoin exposure inside tax-advantaged retirement accounts, Roth IRAs, traditional IRAs, maybe even 401ks eventually. That's huge.
Why is that so significant?
Because growth inside those accounts can be tax-deferred, or, in the case of a Roth, potentially completely tax-free upon withdrawal in retirement. As one Redditor put it, basically, Roth IRA is where the ETF wins. No taxes will be paid, even if Bitcoin goes to $1 million.
Wow. And getting direct Bitcoin into those accounts is usually way harder.
Much harder. Often requires setting up complex, sometimes expensive, self-directed IRAs with special custodians. The ETF makes it seamless within existing retirement account structures.
So those analogies from the sources make more sense now. Owning the actual house versus shares in a real estate fund.
Right. Or carrying actual cash versus using a credit card tied to the banking system.
The steak versus the bologna sandwich one was pretty evocative too.
Haha, yeah. Captures the real thing versus processed proxy feeling for some. Look, the bottom line is, if your main goal is just getting investment exposure to Bitcoin's price swings, especially inside a tax-advantaged account like an IRA,
then the ETF is probably the simpler, more convenient, and maybe more tax-efficient way to go, despite the fees.
Likely, yeah, for that specific goal. But if you care about the philosophy, the decentralization, the potential to use Bitcoin as money, or having absolute control and sovereignty,
then only direct ownership cuts it.
Exactly. And many sources concluded there's no single right answer. It really depends on your goals, your comfort level with the tech, your risk tolerance. Some people might even do both, hold some direct Bitcoin and some ETF shares for different reasons.
Let's zoom in on the tax details a bit more based on that CoinLedger source.
Here.
How are ETF sales actually taxed?
Right. CoinLedger explained it's basically treated like selling any stock. When you sell your ETF shares for a profit, you owe capital gains tax. Just holding them doesn't trigger tax.
And the rate depends on how long you held them.
Correct. For the spot ETFs, sell shares you held for less than a year. That profit is a short-term capital gain, taxed at your ordinary income rate, which can be pretty high.
But if you hold for more than a year before selling?
Then it's a long-term capital gain. Those are taxed at lower rates, 0%, 15%, or 20%, depending on your overall income. This is basically the same treatment as selling direct Bitcoin held for the same periods.
Okay. But you mentioned futures ETFs are different for taxes.
Yeah, they often fall under a different tax rule, Section 1256. The gains are typically treated as 60% long-term and 40% short-term, regardless of how long you actually held the ETF.
So for long-term investors aiming for those lower rates, the spot ETF structure seems more straightforward.
Generally, yes. It aligns more directly with the standard holding period rules.
And just to reiterate, that IRA 401k potential for spot ETFs is the real tax kicker.
Absolutely. Tax-deferred or tax-free growth, that's a massive advantage for compounding wealth over time, avoiding those capital gains taxes altogether, potentially. Plus, brokerages make reporting easier. They send you a Form 1099-B for your taxes. CoinLedger also mentions standard strategies like holding long-term or tax loss harvesting apply.
Okay. What about the bigger regulatory picture now? These things are approved, so what's next?
Well, the landscape is definitely still evolving. The SEC approval brought Bitcoin exposure firmly into their regulatory perimeter, which is new, but regulators are still figuring out the details for digital assets overall.
So more rules might be coming.
Probably. One source mentioned Congress is debating things like maybe requiring custodians or issuers to publish proof that they actually hold the Bitcoin reserves they claim to, so expect more rulemaking down the road.
So the approval provided a regulated path, but it also means more ongoing scrutiny and potential changes. Regulatory uncertainty is still a factor.
It is, yeah. Although for many, the approval itself is a big step towards clarity.
Okay, let's talk other risks. Because having the ETF doesn't make Bitcoin itself any less, well, wild, right?
Not one bit. You are still 100% exposed to Bitcoin's price volatility. That hasn't changed. Remember that example of the fake SEC tweet causing a huge instant price swing?
Yeah, crazy.
The ETF price is just going to follow those swings up and down. The wrapper doesn't insulate you from the asset's inherent risk.
And that research paper you found from the International Journal of Science and Research Archive, it had a really interesting point about the ETF structure itself, didn't it?
It did. It found that these Bitcoin ETFs, unlike maybe a standard S&P 500 ETF, show significant fluctuations in premiums and discounts, meaning the price the ETF trades at on the stock market can sometimes drift away noticeably from the actual underlying value of the Bitcoin it holds.
Wait, really? The ETF price might be higher or lower than the Bitcoin price it's supposed to track? How does that happen?
It has to do with the mechanics of how ETFs are created and redeemed by market makers, especially when the underlying asset, like Bitcoin, isn't always perfectly liquid 200/7 in the exact way needed. The paper called these patterns unstable compared to traditional ETFs.
So that could add another layer of risk, like liquidity risk or tracking error risk.
Potentially, yeah. It's a specific structural nuance of these products that the research highlighted, something to be aware of that you wouldn't face just holding Bitcoin directly.
That is interesting. Okay, one last big area. How is all this institutional money flowing through ETFs changing the Bitcoin market itself?
This is a major dynamic the sources pointed to. The sheer volume of buying from these ETFs sometimes, apparently, buying more Bitcoin than is being newly mined each day, can create what they called a supply shock.
More demand than new supply hitting the market pushes prices up.
That's the theory. And some sources also noted something about the type of investor changing. They observed that the relatively lower volatility seen in some big ETFs, like BlackRock's, might be attracting the bigger fish, large institutions.
And these institutions see Bitcoin differently.
Perhaps less like a risky tech stock and more like digital gold, a long-term store of value for portfolio allocation. This shift, fueled by the familiarity and regulation of the ETF, could change Bitcoin's market behavior over time. Some even speculated it might eventually price out smaller retail investors.
Wow. Lots to unpack there. Okay, let's try and pull this all together for the listener. Based on everything we've dug into from these sources, what's the main takeaway message about Bitcoin ETFs?
I think the core value proposition is clear. They offer a genuinely new way to get exposure to Bitcoin's price. It's convenient, it's regulated, it fits into the traditional financial system, and it offers potentially significant tax advantages, especially via retirement accounts, all without the technical hurdles of direct ownership.
But it's not a perfect replacement. There are definite trade-offs.
Huge trade-offs. You're essentially swapping the complexity and responsibility of self-custody for convenience and regulatory familiarity. But in doing so, you give up direct control, you give up the ability to use Bitcoin as Bitcoin, and you introduce different kinds of risks, counterparty risk, those premium discount issues, reliance on third parties.
So understanding those differences, those nuances, is absolutely key before deciding anything.
Totally. Your choice ETF, direct Bitcoin, maybe a mix of both. It has to come down to your personal situation. What are your investment goals? How comfortable are you with the technology? What's your risk tolerance? And fundamentally, what do you want from Bitcoin? Just price exposure? Or the whole decentralized sovereign asset package?
Thinking through those questions, using the insights from sources like the ones we looked at, that's how you navigate this and make a choice that feels right for you.
Exactly. It's about making an informed decision.
Okay, well, that feels like a pretty thorough deep dive. Bitcoin ETFs, definitely a major bridge connecting traditional finance and crypto. They offer that easier on-ramp, the brokerage access, the IRA potential.
Big advantages for many.
But they're fundamentally different beasts than owning Bitcoin directly. Control, usage, fees, trading hours, specific risks like that premium discount thing, all different.
It's a complex landscape, and you can see why different people land on different solutions.
And just that crucial reminder again, everything we've discussed today is purely for informational purposes, drawing only from the sources we mentioned. This is absolutely not financial advice.
Please do your own research.
Yes, always do your own homework, consider your own situation, and seriously think about talking to a qualified financial advisor before making any investment decisions.
Couldn't agree more.
So to wrap up, here's maybe a provocative thought to chew on, something stemming from all this. As more and more traditional institutional money floods into Bitcoin, largely through these regulated centralized channels like ETFs, how might that start to fundamentally change Bitcoin itself, its nature, its narrative, its use case? Does this drive for mainstream accessibility and integration inevitably clash with, or maybe even dilute, that original vision of Bitcoin as a decentralized, censorship-resistant, self-sovereign asset? Something to think about.